All right, let's jump right into a really common question. You're buying a home, which is huge, but you're not going to be there forever. So, does it really make sense to lock yourself into a 30-year loan? Or is there, a smarter way to play it if you've only got a 5-year timeline? If that sounds familiar, then you are in the right place. This is a classic dilemma for a lot of home buyers. Picking the right loan when you have a short-term plan, it can feel like a real head-scratcher. But don't worry, we're going to figure this out together. And really, this is the whole thing right here. The traditional 30-year fixed mortgage, it's all about long-term peace of mind, right? But if your plan is to sell in, say, 5 years, are you basically paying a premium for 3 decades of security that you're just not going to use? To get to the bottom of that, we have to get really clear on the two main options you're looking at. You've got the old reliable, the 30-year fixed-rate loan, and then you've got its more flexible cousin, the adjustable rate mortgage, or what everyone just calls an ARM. So let's start with the one most of us are familiar with, the 30-year fixed. Its main selling point is just pure, simple predictability. The rate you get on day one is the rate you have for 30 years. Your payment is set in stone, no surprises. Now, on the other hand, the ARM. It plays a totally different game. It gives you a fixed rate for a little while, and then, well, things start to change. So how does it adjust? That's the million-dollar question, right? It's not like the lender just wakes up one day and decides to change your rate. No, there's a specific financial engine that drives the whole thing. Let's take a look under the hood. And the magic word here is index. You can think of an index as a big public financial benchmark that your loan is pegged to. It could be something like the U.S. prime rate, which, tends to move based on what the broader economy and the Federal Reserve are doing. So when that index goes up, your rate goes up. If it goes down, hey, your rate could go down too. That's the adjustable part. Okay, so why would anyone possibly choose that kind of uncertainty? Well, it all comes down to the ARM's single biggest advantage, especially for someone with a short-term plan. Let's talk about the appeal of what they call the teaser rate. And this is the whole strategy right here. To get you in the door, lenders will often offer a lower introductory interest rate on an ARM than you'd get on a fixed-rate loan. Now, if you're planning to sell the house before that lower rate expires, this isn't just a teaser. It's a real chance to save some serious cash on interest payments. So a typical 5-1 ARM is a perfect example. For those first 5 years, it acts just like a fixed-rate loan. Your rate is locked, your payment is totally predictable, and hopefully it's lower than what you could have gotten otherwise. The whole idea is to take advantage of those 5 years of savings and then get out, sell the house before you hit year 6, when that first adjustment is scheduled to happen. Of course, we all know that life doesn't always go according to plan. Banking everything on selling your house at a very specific time, well, that comes with some real risks. You have to understand what could happen if your 5-year plan suddenly turns into a 7 or 8-year reality. And these are the questions you absolutely have to ask yourself. What if that job offer you are expecting falls through? What if the housing market just tanks and it's a terrible time to sell? And here's the big one. What if interest rates across the country have gone through the roof and your monthly payment is about to jump by hundreds, maybe even thousands of dollars? But that nightmare scenario of rates going to the moon isn't totally out of control. ARMs have a critical safety feature built in, and this is something you absolutely have to know before signing anything: the loan's caps. Think of rate caps as your shield. They are hard limits on how much your interest rate can ever increase. There's usually a cap for the very first adjustment, another cap for all the adjustments after that, and then a lifetime cap that your rate can never, ever exceed. Knowing these numbers tells you the absolute worst-case scenario for your monthly payment. All right, we've gone through the theory, the good, the bad, the risky, but how does this all work in the real world, right now, with today's rates? Let's look at some real market numbers. Now, this is so important. We just have this built-in assumption that an ARM will always have a lower starting rate. But as our source material makes very clear, that's not a guarantee. It all depends on what the market is doing at the exact moment you're shopping for a loan. And take a look at this. It's a perfect example. Let's pretend it's July 25th, 2025. In this particular market snapshot, the average 30-year fixed rate is 6.89%. But the 5-6 ARM is actually higher at 7.35%. In a situation like this, taking the ARM gives you zero upfront savings and all of the future risk. It's a powerful reminder that you cannot just assume the ARM is the cheaper deal. But also remember, these are just national averages. The rate you get offered can be totally different based on the lender, where you live, and your credit. Plus, a shorter-term ARM, like a 3-1 ARM, might have a lower rate than a 5-year one. So what's the big takeaway? You have got to shop around and get real quotes from multiple lenders. When you get right down to it, choosing an ARM is basically making a bet on where you think interest rates are going. If rates are on the rise when your fixed period is over, well, your bet didn't pay off and your loan gets more expensive. But if rates are falling, you win. Your rate adjusts downward and your monthly payment can actually get cheaper. So, what's the bottom line? How do you actually make this choice? Here's a simple 4-step checklist. First, be brutally honest with yourself about how likely that 5-year plan is. Second, compare real-time rates from several lenders for both types of loans. Third, if you're leaning ARM, you have to know its index and caps inside and out. And finally, step 4, and this one's personal. You have to look in the mirror and decide how much risk you're really comfortable taking on.
And I think that really brings us to the final question you have to ask yourself. This isn't just a math problem, it's a philosophy choice. Are you trying to buy certainty with a 30-year fixed? Or are you willing to bet on your 5-year plan with an ARM, knowing it comes with both potential rewards and real risks? The right answer? Well, that depends entirely on you.